They are, Laura. You know, traders are watching three major issues as we head into 2010. Here is a list that you should be watching as well. First of all, the SEC is reviewing market structure. That does include controversial dark pools and high-frequency trading. Number two, there's a looming, potentially, Wall Street tax. What that means is buyers and sellers of stocks could potentially be facing some type of tax. And third, the practice of short selling may get yet another revamp. We know short selling was highly critical in the financial collapse of firms such as Lehman Brothers. With me now is Justin Schack of Rosenblatt Securities. He follows all of these issues for the firm. He spends a lot of time here on Wall Street and in Washington. Justin, let's start with the most controversial Wall Street tax. Secretary Geithner telling R.L. Hunt a few weeks ago that this is not a good idea. What if it happens?
Well, I agree, it's not a good idea. It seems to be getting more traction lately. There's more talk about it because it's being reintroduced in the House. There's talk that it may be introduced in the Senate as well. I think, you know, it's hard to argue with the premise of it, which is Wall Street made the mess that the country's in right now economically. Let Wall Street help clean it up. It's hard to argue with that, but I think the problem with it is that it punishes not just the people in the credit markets, the OTC derivative markets, the collateralized debt obligation markets where the crisis came from, but it also punishes all the people here and in the equity markets who are providing a lot of value and are an integral part of American capitalism and the American economy. So.
Who pays for it if it does come to some fruition? The taxpayers, the traders, me as an investor, you as an investor?
Yeah, not so much the taxpayers, I think, but clients, investors will definitely bear the burden, and it'll be direct and indirect. One of the real dangers here is that the vast majority of liquidity provided in the equity markets comes from high-frequency traders, and they get by on really, really small per-trade profits. And what seems like a really tiny tax, when you look at it on paper and you think about it in Washington, actually is very, very significant to them. And the folks that we talk to in that community say that they would basically have to shut down their operations if this tax would become effective. That would dry up liquidity in the markets and raise transaction costs for everybody, retail and institutional investors.
Issue number two, short selling, a revamp of that. Some traders say revamping it would actually help the markets. What do you think the SEC should do? Mary Shapiro is looking for ideas.
Yeah, I actually was lucky enough to speak on a roundtable that they held earlier this year on this issue, and I think what the consensus coming out of that whole process was that we really probably don't need any new restrictions on short selling. There are things that the SEC has done that have cut down on naked short selling, which is really where the abuses come from, and that the rest of short selling is a vital and important part of capital markets. I think what the SEC is doing is they put out a whole raft of potential solutions. They've asked for comment, and that process is still open. I think there's probably going to be more political pressure to move on it, and there will be something, but we're hoping that it's, you know, the effect of it will be minimal and that it wouldn't have the same type of effect as, say, a transaction tax on drying up liquidity in the market.
Okay, and finally, high-frequency trading. This continues to be one of the most controversial issues. What do you think might happen to that practice as we head into 2010?
I don't think there's going to be a major diminution of high-frequency trading or any major regulatory change. There are a couple things like sponsored access, where some brokers are allowing high-frequency traders to access markets directly without the proper risk filters. That could create systemic risk, and I think the regulators will probably address that. But as far as anything else that would diminish high-frequency trading, I get the feeling that the regulatory community, if not the political community, appreciates the value of high-frequency. It is not going to want to do anything to really harm it.
All right, it's going to be an interesting 2010. We're going to leave it there. Our thanks to Justin Schack of Rosenblatt.